Now, before we get into the product side, we'd like to remind you, please like, share, subscribe. Your comments are appreciated. We love to hear from you, and your support is always appreciated. So when we look at what's happening with the USA product supply, this is why we always try to look at averages because it can get that noise in between. So we had that spike that we were expecting. It was a little bit more than even our expectations because we thought gasoline was going to grow, but we were going to see that walk back in jet fuel. Instead, the walk back in jet fuel was a little bit lighter than expected, but gasoline had that move. So the current came in at 14.35 million. You can see how it's just below, what is that? That is 2017, 2020. And then, but when we look at what is it first, last week was 13.625. So the average comes out at 13.616 million. We think that it's going to pull back a bit because we're assuming 13.4 to 13.5 million makes sense over the next month or so, just given kind of what the activity looks like, how things are adjusting. And that's where we're going to kind of go sideways at this point. When you look at that solid yellow line, that's where we think you have to kind of focus your eye, especially when we get some of the sloppiness on demand, given what we've seen from Gas Buddy, Descartes, and in terms of where that future demand is going to be over the next week or two. So when we look at distillate had a nice draw, again, of 3.42 million. Just to be clear, it's supposed to draw at this time of year. Just look at the average. You're supposed to have that draw. The question is always going to be, what is the pace? And you can see that the pace is starting to accelerate, which is a net positive in terms of where things are. Unfortunately, that's going to start to slow down in terms of where things are being produced, how are they being consumed. And we do have essentially a floating armada now that is coming from Europe of both not only just gasoline, but also distillate. So there's some caveats in that. One, Europe had about a year's contract, or a contract that lasted for about a year on storage of refined products, and that is expiring. So the question is it cheaper to renew it for another year or to just sell it? And just given what has just happened, it is going to be perfect to sell it. So that will keep these imports elevated. And just to give you an idea of how elevated are they, even though it increased only by 6,000 barrels, you have to look at the year over year and the 5-year average change. So we're about 235,000 barrels a day over the year over year, and 129,000 over the 5-year average. So we still have that that surge of distillate, and that is accelerating again, given where we see some of these heat cracks and where we see the distillate coming into the Pad 1 or the East Coast. Because obviously, anyone who lives around our area knows that it's been cold. That obviously pulls down more heating oil, which is diesel, and again, this is going to keep some of these imports there. It'll start to, the distillate has pulled through the system because, again, there's that timing delay. So some of these draws will slow. It's still going to be a net draw. It's just the pace of them is going to normalize again, because you can see where that dotted line is and what that average typically should be at this time of year. So we're still over that level. It's just a matter of how can we get back to it before we start to see those builds that again normally start to come in the shoulder season, which is picking up in March, April. Here's just an idea of just how strong demand has been. Demand remains elevated. We were assuming to see some of this moving, obviously still above the 5-year average, but moving in a bit more of a seasonal norm. Instead, it pushed to the upside. That'll normalize down, but again, not enough to get to the 5-year average once we start to again normalizing it, because we could get a big drop just based on when this demand is recognized, because this is a calculated number. So obviously, there's been some big adjustments in the market is over the last few days. But the one thing that we can say is that trucking remains very, very strong. And now we came in at 138. We still think that we're going to get a pullback just as things start to normalize, and we're starting to see that in rail, as we've been talking about. Obviously, the issues are going to be large, just given the problems on interstates, a lot of these movements. But with that being said, load availability is still accelerating. There's more stuff to move just because we're starting to see some of that pull through in the supply chain, getting some of that normalcy. we're starting to see a little bit of a creep higher in diesel prices. Anyone that has been to the gas station knows that gasoline prices have gone up. So have diesel prices. It's just how quickly does that go through the rates, because typically the shipper will pay for it, not the truck. It's usually just a pass-through cost. So as that starts to go up, how much does that cost? Does that start to weigh in? We've already seen import prices accelerate today. We've been talking about inflation. We've been talking about prices paid, prices received. We did another show on it in our economy show, just looking at the inflation levels and how it's really coming through on not just the demand side but the supply side as well. When we shift over to rail traffic, here you can see that total carloads is down 7%, but it's again just coming to where the total traffic is. We were expecting a walk back. Chemicals we think is going to be fairly flat. As we've been saying, grain, forest product, especially grain, it's up 25%. That's not stopping. Over the longer term, that's not stopping, and that's even the longer term over the call it the next 5 weeks, because there has been a massive hiccup just because obviously you can't get rail cars to the port right now. So we will get some of this decline as some of these hopper cars wait in line to get into their to the ports. So that will mitigate some of that grain movement. But again, that's going to be transitory at best. Motor vehicle, as we've been saying, we've been seeing a lot of slowdowns with the shortages that have been coming through in terms of shortages of semiconductors, which is hurting production, cutting things down, non-metallic and petroleum products. Petroleum in general is going to see an acceleration just because we are going to have a big movement between different pads, movements to rejuice the system. Right now, Colonial is saying that they are not having issues. Empirical is down, so it's kind of just going to be a matter of who's moving where. Intermodal starting to normalize. As we were saying last week, it was going to continue to normalize. That's not going to change. It's still going to be up year over year. It's just not going to be in double digits. It's going to be in upper single digits, anywhere between, let's call it between 6 and 8% versus last year. And then that's going to put total traffic fairly flat. Next week, we think that obviously there's going to be some sloppiness, but that will normalize as a lot of this is transitory and we still have more product to move through the system. Looking at ships at port, when we start looking at Los Angeles, you can see that we still have the accelerations when we look at February. But when we look at the front week, you can see that change year over year. We're starting to normalize a bit. We continue to see some of these, some of the delays work their way through. And when we look at change from previous week, you can see as we get into March, we're starting to see some of these declines as some of this activity normalizes. Import prices are going up. That's going to slow down some of these new imports. As we talked about in the economy show, we keep seeing price increases at the exporting level. That's China, Taiwan, Japan. There's only so much that they can do to protect some of those pricing, and that's going to push through. We're seeing it hit our shores now, which is again going to slow down some of these purchases as inflation or pricing is managed. This is something that I hope warms everybody's heart, both figuratively and literally. Here you can see some of this warm weather is going to come back into a lot of these areas that are seeing some extreme cold. This will help some of the normalization. This is obviously going out over the next 2 weeks. This will normalize some of that distillate demand that I've been talking about. Once we pull more of that through the system, get everybody up to speed, that's why we're going to get a big spike in demand, a big drop in demand. And then once we get through there, we'll start to see some of this normalization. The same can be said about gasoline, as just people are doing less given the weather impediments that we're seeing. With that being said, gasoline had a smaller than expected build. The build was 670,000 barrels. You can see it was pretty much a build in pad 1, pad 3, pad 4, small declines in pad 2 and in pad 5. Nothing is really going to change based on what we're seeing. Obviously, we're going to get we're expecting a bigger gasoline build next week just because there's just less movements. Again, we restock some of the the gas stations. And when we look at imports, you can see imports were up 15,000 barrels a day. Based on the arbitrage right now, RBOB had a huge spike, which is something that for anyone that watched me on Bloomberg, I was saying that in these situations, you typically buy gasoline, sell oil. That played out, and it's continuing to play out right now. But that opens up a big arbitrage. So the ARB was already open to bring gasoline from Europe into the U.S., and now it just blew wide open. So they were going to get a new surge of gasoline into the market. It takes time for that to happen, just given obviously sailing periods, but we will see an acceleration of imports over the next 2 months for the most part coming into the U.S., especially given how poor the gasoline market remains in Europe. Now, as I keep saying, in terms of demand, underlying blending components remains to be a big one. You can see that refiners continue to target the blending side, and that's octane. Year over year, we're up about 900,000 barrels. We're over the 5-year average by about 4.1 million barrels. That is only going to accelerate, which again is going to cap some of these margins that I think are expected in the summer months. This just kind of puts it into perspective when you look at where we sit on the blending component side, and based on imports coming in, focus on octane, this is going to continue to push to the upside. And when we look at the yield in general, so when we look at gasoline, the yield right now went up, at the refinery level, we had an increase of about 62,000 barrels a day of gasoline, and a decline of distillate by about 87,000 barrels a day. So there was a pivot to gasoline, again, trying to draw down some of that distillate just because gasoline has some of that flexibility. We are getting to, when we look at the 5-year average, gasoline is now 1 million barrels over the 5-year average. We're still 2 million barrels below the 5-year average, below the year over year. But that is going to accelerate just given where we're going to see these hiccups and the drop in demand, which again is going to put more gasoline in storage. And then we have more imports, so that will push us into that seasonally adjusted all-time high. And I think the blending components is speaking to how that is very likely going to happen over the next week or two. Here's where we look at gasoline supplied. You had a big surge up to 8.4 million barrels a day of demand. We're assuming we're going to live between 8.1 and 8.2. So again, we had that pop. We think that we're going to suck around the bottom of that cloud. This is going back to 2006 just to look at what recessions look like in general. Unfortunately, and again, we keep saying this, but inflation mixed with terrible jobs numbers and really limited employment is going to keep people from being as active as I think the market is hoping for. We had a big surprise to the upside on unemployment claims. That's remaining sticky, which again is reverberating and showing up in a lot of these high frequency data points. So new COVID cases is very positive. That's going to, we'll talk about that in a minute. Deaths is also getting better, a net positive. Lockdowns is better. We're now below 70. The bigger issue remains those jobless claims as we're back over 800. We came in at about 860,000, well above estimates. And that's leading into people doing less, the consumer confidence remaining weak. Again, general activity, which is showing up in the Dallas Fed mobility, where things have essentially flatlined, where we're not seeing too much to the upside or downside. We're just kind of holding water and going sideways. And now, mind you, these numbers are including Pad 5 reopening, California reopening, restaurants opening in New York. It's just, as I've been saying, and based on people that we've talked to, a lot of parts of the country have opened already. And it's just going to be a matter of how much more do they open. And the biggest question is going to be that weekday number, because even though people have, let's just say we're about 10% below normal on the weekends, we're about 60% below normal on the weekdays. And that's where we have to keep looking on when do companies start bringing people back into the office. And that's when we'll start to see some of this normalization to the upside. But again, we think it's going to be fairly muted given some of these individuals, or at least 21 million, do not have jobs or are getting some form of unemployment because they don't have their same hourly work. And that's going to keep the lid on some of this activity throughout the throughout the year. And this is just looking at that 7-day average. You can see what we're talking about showing up in that workplace, pretty much flatlining in general. According to Pay with Gas Buddy, again, this is a calculated number, and this is why we want to talk about what we're talking about. So Gas Buddy had their EIA model. They thought retail demand was going to be at about 7.84 million barrels a day, opposed to EIA's 8.4. But again, it's that timing component, because it's a matter of who is buying it at the pump and when is it being refilled. So now that we've had this big surge, I think we're going to come much closer to the Gas Buddy number. Descartes had us at about 8.29. So if you think about, again, that normalization. Sorry, my nose is clogged because my kids are sick and now I'm getting a cold. So we're seeing kind of where we're normalizing in general. But just to give you an indication of how bad gasoline demand is right now, according to Gas Buddy, gasoline demand for yesterday was down 13.9% from the Monday prior. So when we think about Monday over Monday, it was down 13.9%. And if you just look at what has happened in Texas, the Midwest in general, because I always try to bring it up, but a large part of the driving in the U.S. is not in the Northeast. It's in the Midwest, the South, and the West Coast. And if you look at just the amount of snow and inclement weather that is hit in different locations, that's going to put that lid on that demand over the next 2 weeks. So we expect to see those numbers be between, let's say, down 8% to 15% over the next 2 weeks, which again will impact demand in general. Mobility, here's right now the U.S. is fairly flat. It's, there's not much to say it's going to go up or down. We think just based on what we're seeing, it's going to trend to the downside. But again, Apple mobility is kind of a skewed number based on how they calculate. And here you can see Europe has gotten a little bit better, but still flatlining, at this depressed levels. But on the bright side, what do we have? We have COVID cases going down through a floor. We have hospitalizations going down. We have daily deaths going down. So again, everything is moving in the right direction. As we've been saying, we were expecting to see a big drop. And then as we got into March, we're expecting to see a little bit of a pop, obviously not to the levels that we saw for the holidays, but this is going to be another, again, kind of that rolling average, which will be a net positive in general for activity. When we look around the world, you can see worldwide cases have remained fairly flat. The U.S. on their downward trend. Europe has flatlined. Again, this is where we continue to see some problems as to how quickly can Europe normalize. Asia Pacific is something very similar where we keep seeing mixed data. Japan continues has flatlined, which again made them pause the reopening, which we talked about in Econ segment 6. India maintains the course of that steady decline, which is a net positive. South Korea has had a little bit of a surge, again, which is delaying some of the activity and reopening that's going to happen in South Korea at the moment. And then Germany has flatlined, and they've come very close to the target that they've been aiming for in October. So they're supposed to reopen the middle of April. If they can hold these numbers, we're assuming they can pull that forward a little bit into March. We don't think it'll be February, but it'll most likely be some reopening in March versus April, which again would be a net positive. Then when we look at COVID vaccinations, the U.S. has accelerated. The UK, UAE, Israel have accelerated, which is a net positive, especially as we look at how many people have received their first dose versus their second dose. Some of the caveats that are coming in is, it's always mixed as to who do you listen to, who do you read. Some scientists say that the South African variant is different, and some of the vaccines won't be as effective, and some are saying that that's not true. So again, we're going to have to let the data play out. It is a coronavirus. There are multiple different strains of the flu every single year. If you get a shot in New York, a flu vaccine in New York, it will be very different than the flu shot you got in Florida. So again, there's different strains, there's different things. Net, it will make people feel better. It will make them feel more confident to go about their daily lives. Unfortunately, the news, and governments scared everybody to death. And now it's nice that you can have a certain amount of comfort in a vaccine, which will help people come back out of their shells, back into normal daily life. Will this go away? No, it'll always be with us. It's just a matter of how does it change over time and just become part of hopefully just a yearly vaccination, or just become some sort of bad flu that can then be included in the flu vaccine. These are things but in net, it is an overall positive to general activity and normalcy in the economy, which then gets more complicated as we talk about in the econ show of jobs. And just because you got a vaccine doesn't mean you're going to get hired back, or, people still don't have as much money. So again, those are things that we talk about in the econ show, but net, this is a positive for general oil and energy demand. Jet fuel had a small walk back. We had a draw of about 760,000 barrels. This is one where we think there's going to be a bigger step back of jet fuel demand, just again, as we see more flights getting taken off the list. Obviously, inclement weather is going to ground a lot of flights. This will leave jet fuel at the airports, which means they won't have to buy as much. So this, again, we're in that range where we're expecting between that, let's call it, 750 to 1,000 to 1 million. And we think we're just going to come back down to that low that we achieved in the end of Jan. And when we look a little bit further, why do we say that? Well, some 1,700 fewer departures on average each day, week on week. Obviously, China had a huge drop with their Lunar New Year, and people really weren't moving all that much as they started cutting flights early. Here you can see the U.S., those drops are driven by the inclement weather. And then Europe continues to move lower. So more than 10% of flights scheduled to depart this week in China have been cut. So again, even they were expected to, they've been cut. So again, walking back just total airline demand in general. And right now, the March week over week, there hasn't been much change, as we've been highlighting, and BNF has really been highlighting, is that, the week over week, March has been coming down, in blocks of 1,000 for March. And that's just try to protect pricing, take some of the capacity off the market. Again, as we keep looking at how are they going to try to flatline some of these the airline tickets, and try to keep capacity fairly tight in general, just because they're losing a lot of money at this point. Here we had a pop going into President's Day weekend, and as you can see, just versus last year, we always have a pop this time of year. So it's seasonally expected, and then obviously it dropped off. You had President's Day weekend, which people go away for. We also had winter break. I know people that were traveling with their kids. Some people want to try to get back to normal. So we had the pop, and now we had the fade back into that range. Again, there's nothing to say, just based on what the March schedule for airlines looks like. We don't see that changing all that much in the near term. Open table, here you have that nice little weekend spike, and then the cold struck. This number is coming down just because no one's really going out to eat, just given the weather. So it'll be transitory in general, but you can see kind of what's hitting. Global is well within our range that we keep talking about on the weekdays of that 50 to 55. Weekends has gotten better in general, tightening to about 45 to down 40 to 45%. Australia holding strong. Canada, Germany, Ireland, UK, no change there. Obviously, the US will see a drop, but again, transitory in general as things start to normalize, and we do have more capacity for restaurants in the Northeast, which will help some of these numbers to the upside. So again, some positives, but it's going to be a sloppy number through the remainder of the next few weeks, and we'll try to help you, work through that in the best ways to plan coming forward.